This entry into the history of financial futures is sponsored by Eurex.
Baer Marks Upham. At the time, it was a small, very small firm down on Wall Street, but it represented a couple of very prestigious clients, Shearson Hayden and Comex Clearing Association. And this was in 1975 when I first started working there. CFTC came into existence around that time. And all of the exchanges had to submit their rules to the new CFTC for approval. And Comex had a problem with one of its rules, and I was one of the associates that was tasked with going down to Comex and going through all of their papers from the beginning of the exchange's existence to determine what other processes or practices constituted rules that should have been submitted to the CFTC. And that's how I first got involved in this industry. From there, I went to JP Morgan, and that was in 1979. At that time, banks had just been authorized to trade gold, to trade bullion again. The foreign exchange markets were taking off, and interest rate futures were being traded, and the government securities futures were being traded on the exchanges in Chicago. And so JP Morgan started participating, trading in futures, which they hadn't previously done, and started trading in fairly significant amounts. And that caused the firm to look broadly at its exposure to the exchanges, to clearinghouses, and to the FCMs that they were dealing with. What happened was a study group was put together, and I was the representative from legal on that group. I was the only person in the legal department that actually knew what a futures contract was because of my experience at Baer Marks. And the group was tasked with determining whether or not JP Morgan should form its own captive FCM, primarily to better manage the credit risk that it had as a result of trading in the futures markets. Secondarily, the group also looked at the possibility of using the FCM to actually execute and clear on behalf of customers. And the group came to the conclusion that, yes, it would be a very good idea for JP Morgan to be a clearing firm and an FCM. And the firm would still trade through a number of different executing brokers, but all of the exposure would then be consolidated in what was then Morgan Futures Corporation. And that was really why JP Morgan decided to get into the business. And I think a lot of the other large banks were coming to the same conclusion because of the growing trading in bullion and bullion futures, in government securities futures and interest rate futures and foreign exchange futures. But JP Morgan was the first to apply to the Fed for approval to become an FCM and to actually obtain approval for that. There were a lot of legal and regulatory issues. First of all, any activity that's going to be undertaken by a bank holding company, even if it's in an affiliate of the bank or a subsidiary of the bank holding company under Fed guidelines, has to be closely related to banking. So the Fed had to make a decision first that, in fact, brokering futures contracts, clearing futures contracts for customers was an activity that was closely related to banking. Now, JP Morgan went to the Fed because at the time it was a New York State bank, and Morgan Guaranty Trust Company of New York was a New York State bank, and JP Morgan was the holding company. It's different now. JP Morgan, as most of the large banks, are now national banks regulated by the OCC. Over time, there were banks that chose to organize their FCMs as bank holding company subsidiaries so that they would be supervised by the Fed, and others which chose to organize their FCMs as a subsidiary of the bank, in which case they'd be regulated by the OCC. And the Fed and the OCC started taking very different approaches to the approval of FCM activities. The Fed, as I mentioned before, looked at whether the activity was closely related to banking. And oddly enough, the focus was not on the activity of execution and clearing and settlement to determine whether it was closely related to banking. The underlying asset classes of the contracts to be traded. And in the Fed's view, initially, only closely related to banking, that standard led them to approve only interest rate, bullion, and government securities futures contracts for JP Morgan initially, because those were all underlying assets which the bank could trade. Whereas the OCC, once it started approving bank FCM activities, looked at the activity itself, looked at whether execution and clearing and settlement were similar to the other activities that the bank was engaging in for its customers. So they took very divergent approaches, and certain banks engaged in a bit of regulatory arbitrage. There was one bank that organized two FCMs, one under the Fed, under the holding company, the other under the national bank. And it went to either the Fed or the OCC to get approval for new products. And each time it did, it pushed one of the regulators to broaden its thinking and its determinations as to what was acceptable banking activities. And the OCC was much more liberal. So by going to the OCC and getting approval increasingly for security index futures contracts or energy contracts or agricultural contracts, it was pushing the Fed more broadly consider what activities were closely related to banking. And over time, the Fed did adopt the OCC's approach and started looking at the activity itself. It slowly came to the conclusion that all futures contracts, in fact, are financial in nature. And so therefore, it no longer focused on asset class in determining what a bank could broker and clear for its customers. I think there was two sources of tension between the New York banks and the Chicago exchanges. One was focused on their FCM activities. The other was focused on their over-the-counter activities. So there was a war being waged along parallel tracks at the same time. I think it was more the FCMs than the exchanges which were concerned about the formation of bank-affiliated FCMs. And that was purely competitive, a competitive concern. They were concerned if the banks with all of their customers and all the capital that they had, would slowly take customers away from the traditional FCMs, and with their big balance sheets, be able to clear more exchanges and a broader number of products. At the same time, the banks were starting to trade swaps, interest rate swaps, and then FX swaps. And the exchanges were opposed to that also for competitive reasons. They saw the developing swap market as taking business away from the futures market. So you had the FCMs opposed to the banks' FCM activities, and the exchanges opposed to the banks' over-the-counter activities. But those FCMs were also governing the exchanges and the clearinghouses at that time. So the exchanges took positions, the clearinghouses took positions that were intended to make it difficult for bank-affiliated FCMs to get the necessary legal and regulatory approval that they needed from the Fed. And in particular, the CME had adopted a rule that required that if a bank subsidiary was going to become a clearing member, it had to have a parent guarantee. And they knew that that was going to be problematic with the Fed, because the Fed was very concerned about clearinghouse exposure and what was then, at least on the CME, good to the last drop. So it was an effective way to kind of slow down bank-affiliated FCMs. But in the end, JP Morgan was certainly able to negotiate a guarantee that was acceptable to the Fed and acceptable to the CME. So ultimately, it was approved as a clearing member of CME. It was very interesting because this was at a time when ISDA was in formation. The New York banks were really being represented as a group by the New York Clearinghouse. And I remember being at a clearinghouse meeting and with representatives of the other banks, and the clearinghouse banks had retained Tom Russo at Cadwalader to represent them. And we had a meeting there with the exchanges, and the exchanges took the position, of course, that the swaps were in fact illegal off-exchange futures contracts. And we saw that that legal argument kind of play out in a number of different forms, either in CFTC rulings, legislative initiatives that were intended to really hamper the growth of the over-the-counter market. I think it was short-sighted on the part of the Chicago exchanges, and I think CME came around to understanding that, in fact, these markets weren't necessarily competitive. In fact, they were somewhat complementary. And the first indication of that, to me, was when CME adopted an exchange of swaps for futures rule. And it seemed that they finally realized that there was really a lot of synergy between the Eurodollar futures contracts and interest rate swaps. And the banks that were trading interest rate swaps with their customers were going to be laying off some of that exposure using Eurodollar futures contracts. And so, in fact, the growth of the swap market was also likely to cause a growth in the Eurodollar futures market. And that is exactly what happened. Gene brought me to the OCC primarily to address swaps activities and banks swaps activities. But in fact, my responsibilities were broader than just banks swaps activities, and it included their derivatives trading activities and their trading activities more broadly. And after we issued the first bank supervisory guidance for the management of the risk that banks had arising from their derivatives activities, we then looked at other products and traded areas. And one of those was structured notes. And a number of small banks that were relatively unsophisticated purchasing structured notes without completely understanding the risk associated with them. And they were, in fact, losing a lot of money. So we issued guidance around risk management for structured notes and the kind of due diligence that small banks needed to do before they started engaging trading in structured notes and purchasing them because they thought that they would make the bank more profitable. Similarly, we issued guidance on banks' emerging markets activities. Banks in the 90s were starting to trade much more actively in emerging markets, and there were serious concerns about sovereign debt of a number of different countries. So we issued guidance on risk management of emerging markets activities as well. Barings was a wake-up call to banks generally about controls and the integrity of their controls, not only in head office, but in remote offices, and their controls with small trading operations in those remote offices. It was a wake-up call for the regulators because the UK discovered, or maybe they knew it before, but didn't have the ability to examine Barings' activities in Singapore, because Singapore law didn't allow a foreign bank regulator to come in there and examine their bank's activities in Singapore. In the U.S., we found out the same thing as a result of Barings. The U.S. bank regulators also didn't have the authority to examine U.S. banks' activities in Singapore. I was at OCC, and OCC is part of Treasury. The decision was made very quickly that we needed to address that problem. And so I was dispatched to Singapore to meet with the number 2 of the Monetary Authority of Singapore. And I actually flew all the way there for lunch with the number 2 guy at the Monetary Authority of Singapore to open up the discussion on how the OCC, the Fed, and FDIC could potentially examine the activities of U.S. banks in Singapore in the future. It was certainly successful because ultimately we were able to get that authority from the government of Singapore. The value proposition that attracted me to BrokerTec was, once again, being more actively involved as counsel in the exchange-traded markets. I had been doing that for 13 years. I was at JP Morgan altogether for 14 years, 13 years at JP Morgan before I went to the OCC. Now, I regulated those banks' activities at the OCC for 3 years. Then I went to Arthur Andersen, where I was a consultant. And though I was still involved in the derivatives market, I felt somewhat removed. But I think the real value proposition that BrokerTec had for me at the time was that it wasn't Arthur Andersen. And I was glad to get out of there, and my timing couldn't have been better because it was almost exactly a year later that Arthur Andersen imploded, and the partners there lost their partnership capital. I was able to get out of there before that happened, but it was also the part of the value proposition of BrokerTec was that it was new, it was a startup, and it was once again going to potentially transform the exchange-traded derivatives markets. And in fact, it did that. Many people think that BrokerTec didn't succeed because BrokerTec Futures Exchange and BrokerTec Clearing Corporation didn't survive themselves. But I would say that BrokerTec succeeded in exactly what it wanted to do, which was to, one, lower fees for large trading firms, to get more flexible block trading rules, to encourage more cross-margining in the industry. BrokerTec talked a lot about fungibility of the government bond contract that was traded on BrokerTec with the government bond contract that was traded on the Board of Trade. But the issue wasn't really fungibility. The issue was the ability to margin and cross-margin your exposures between that you had at different clearinghouses. And as I said, I think BrokerTec ultimately, and of course the primary thing that BrokerTec was doing was trying to push the industry to an electronic trading environment from open outcry. I mean, people forget that back in when BrokerTec was formed, all the trading was still done in the pits, other than block trades. And the idea of electronic trading, I mean, even there had been opposition before to that because under the Commodity Exchange Act, because there was no open outcry associated with the execution. And the Commodity Exchange Act does say that futures contracts are executed by open outcry. So BrokerTec did push the envelope that way. It one, helped move the industry toward electronic trading. It did the competitive pressure that BrokerTec placed on the existing exchanges did cause them to lower their fees, at least initially. There is cross-margining and broad cross-margining across securities and futures products now. And certainly the block trade rules at the existing exchanges became much more flexible also. So I do think BrokerTec succeeded in what it wanted to do, just didn't survive. One of the challenges that BrokerTec had from the beginning was that it was strategically important to senior management at our owners. It was important to them for all of those reasons I was talking about earlier. Fees, fungibility, cross-margining, but we depended upon the traders. And the traders had a very different view about BrokerTec than senior management. We were important strategically to the senior management, but the traders didn't want to trade on BrokerTec. We didn't have liquidity on the platform. They wanted to trade in Chicago on liquid platforms, and that's certainly understandable. So there was a conflict within the firms in terms of their support for BrokerTec. Yes, we had the capital from senior management. We didn't get the trading from the traders other than what they were minimally committed to doing, which is really more market making than a commitment to actually trade. But they were market making commitments, so that they would stand ready to to buy and sell if anyone came to the market. I rejoined my old boss, Gene Ludwig, who was he had been the controller of the currency. And I remember while I was at Brokotech reading a report about the $250 million FX trading loss of Allied Irish. And I read the report because it had Gene Ludwig's name on it. And he was the one who had hired me away from J.P. Morgan to join the government. And I read the report and I thought, this is really incredible. First of all, we hadn't seen in the past that kind of report on the trading losses at a large firm. That kind of transparency around what had happened, what contributed to those losses, where the weaknesses and controls or governance were. And I thought, this is really good stuff. I would have liked being involved in something like that. Well, I got the opportunity because I helped negotiate myself out of a job with the acquisition by Eurex. All during that time, I kept in contact with Gene, and I sought his advice as to, what should I do next? And he said, well, you can always come join me here at Promontory. We're doing good work, and I really need some good people. And I said, absolutely. And I was happy to rejoin Promontory. And that was when the firm was small. I helped establish the firm's New York office with Elizabeth McCall, who had just left the banking department, New York State banking department, where she'd been superintendent of banks. And we helped form the New York office at the same time that Conrad Alt was out forming the San Francisco office. So all of a sudden, Promontory went from a small firm in D.C. to a firm with 3 offices in the United States. And then it seemed in no time we had 16 offices around the world. And I think one of the best reputations among the consulting firms in the business. Gene built a great firm, and I was really happy to be a part of the growth of Promontory. Of course, now we've been acquired too, and we're part of IBM. So I was really happy. I was really surprised. I was instrumental in getting the approvals for J.P. Morgan to expand its FCM business over the years. And that had ramifications for the financial services industry broadly. And then my role at the OCC was probably the most important role that I've had. I issued the first bank regulatory guidance on how banks should manage the risk of derivatives. And that guidance, a lot of that guidance, you will find some of the basic principles and tenets of it embedded in Dodd-Frank Act, at least in the risk management principles, program aspects of the Dodd-Frank Act. That was not insignificant, and I think Brokotech also helped change the industry. So I'm happy to have been involved in a number of initiatives that I think have expanded the industry, changed the industry. I'm not saying I changed the direction of the industry at all. It was just the direction the industry was going in. But I was happy to be a part of those changes.
John Lothian News would like to thank those individuals who have contributed to our Markets Wiki Education GoFundMe campaign. Their financial assistance allows us to produce and distribute videos like this for our Open Outcry Traders History Project or the Path to Electronic Trading video series. Join them in supporting John Lothian News, capturing the history of our industry.